Hi, everyone. I'm Brendan Walsh, Certified Financial Planner with Quantum Leap Capital. Welcome to our first ever webinar. Thanks for joining us today. Before I get started, let me go over just a few ground rules. First, if you haven't noticed already, we have a slight delay between my words and your ears. So to avoid confusion and get you all back to your day on time, I'm going to ask that you enter any questions you have in the chat bar on the right-hand side of your screen, and we'll leave 10 or so minutes at the end to answer as many of them as time permits. Second, the recording of this webinar will be available on our YouTube page for the next few days and on our website. While the first priority for hosting this event is to arm you with information that will help you financially, the second is for us to let the world know what makes us different from the hordes of other financial advisors that are just pushing the financial institution's self-serving agenda. So please share it with your friends and family, but only the nice ones. All right, let's dive in. I thought I'd start today by reviewing a little history to provide context for the material I'm going to cover. For those of you that currently work with us, some of this will be review, but I promise there will also be some information you'll hear for the first time, so don't click out just yet. This first chart shows the history of U.S. income tax rates and our debt level. I'm not going to get into the details of the charts because that would consume all the time we have, but instead I'll simply point out that tax rates have declined sharply over the last 30 years, while our debt level as a country has jumped to heights we haven't seen since World War II. If we're to preserve our credit standing with the rest of the world, which is paramount to maintaining our achieved standard of living, at some point we'll have to rein in our debt accumulation, and there are really only two levers we have to pull to make this happen. One is the increasing tax revenue lever, and the other is the decreasing spending lever. While total tax revenue has increased over time until year 2001, as you can see from this chart, income tax revenue has actually trended downward since the 50s. Then it dropped like a rock in year 2001. That drop is primarily due to Congress's response to the recession that stemmed from the burst of the dot-com bubble. At that point, Congress passed a little tax law called EGTRA. EGTRA was written with a sunset provision in order to sidestep some guardrails intended to contain our debt, and we were supposed to revert back to pre-2001 tax law entirely by 2010. EGTRA's advocates argued that by reducing tax rates sharply and temporarily, growth of economic output would be so stimulated, this would lead to all the revenue the government would need to balance the budget. In fact, the Heritage Foundation went so far as to publish a report that said EGTRA would lead to the complete elimination of our national debt by year 2010. So we all know how well that worked out now. But that's not the main thrust of our discussion today. We could dedicate hours of debate to that topic, and I know it sounds like fun, but instead we're going to talk about the tax and investment planning implications of these long-term trends, which will be lots more fun. So what do these trends mean to you? Let me answer that question with a question. Thinking on these images, do you think tax rates will go down, sideways, or up in years to come? Most people say up, and I'm one of them. In fact, they already are. In 2013, after 3 years of extending EGTRA's temporary provisions, Congress let a bunch of them sunset. The top marginal bracket increased from 35% to 39.6%. A laundry list of deductions that regular folks like you and me were using went the way of the dinosaur. And 77% of all American households paid more in tax than they did the year before. So it wasn't just the wealthy that paid more. Almost everyone did, and still is. So any person that actually knows anything about investing will tell you it's not what you make, it's what you keep. But the majority of investment advisors out there don't know what tax planning really is. They preach that a high enough return will outweigh any increased tax liability that results, and theoretically that's true, but it doesn't seem to work for individual investors, at least not with any consistency. To most advisors, tax planning is simply telling their clients they need to save more in their IRAs. Of course, their fees are based on those IRA values, but that's beside the point. Let's be clear. Traditional IRAs and 401ks don't save tax unless you end up with a lower tax rate when you take the money out, and you will take the money out. Traditional IRAs and 401ks postpone tax. They postpone tax until you draw the money out, which for most people is when they actually have the least amount of financial flexibility to absorb the impact. I had a new client call this week asking about her grandmother's required minimum distribution. She has power of attorney for her grandmother and was told by her grandmother's Merrill Lynch account manager that grandma didn't take her 2015 required minimum distribution, and that the penalty is 50% of the amount that was supposed to be distributed. Unfortunately, this is how a lot of people find out that the tax postponement doesn't last forever. Investing in ways that will mitigate the taxes you pay in the future is a critical aspect of any long-term investment plan. Look at it this way. If you're in the 25% tax bracket and I help you keep $1 you'd have otherwise sent to the IRS, that's a 25% return. Let me say that again, because it's an important point. If you're in the 25% tax bracket and you keep $1 you would otherwise have sent to the IRS, it's a 25% return. There's no fund or stock out there that will produce that with the same consistency and reliability. The main reason we planned this particular topic for today is this time of year is when we begin badgering our clients to get us their year-to-date income and expense figures so we can project their taxable income for the current year before December 31st goes by. These last 4 months of the year are when tax planning happens, not the time between receipt of your W-2s and 1099s and April 15th. By that time, the ship has not only sailed, it's halfway around the horn. When I ask people that don't work with us what kinds of tax planning strategies their advisor's been working on with them, the typical answer is, oh, I have a CPA. Fabulous, I say. When do you meet with them next? In April, of course. So I'm not bashing accountants, far from it. Accountants do the part of this that I don't want and can't do and can't do. They put the numbers in the right boxes and tell us what we owe. This is obviously a gross generalization, but most accountants aren't trained to be tax planners. They're trained to be accountants. They account for what has already happened. Similarly, 99% of financial advisors aren't trained to do tax planning. To the contrary, advisors who represent a broker-dealer are strictly forbidden from giving tax advice because those broker-dealers have experienced losses when account holders have sued them for taxes they didn't expect to pay. Bottom line, if you aren't evaluating your current year tax situation every year at this time and looking for ways to reduce taxes that are due now or taxes that are coming 15 or 30 years from now, you will end up paying more than you have to. And I'm not talking about a few $100. This is big money. So I noted a few minutes ago that income tax rates have been increasing since 2013, but they're still very low by historical standards. So one of the strategies we commonly look for is to make sure our clients are filling up the lower brackets. That is, paying tax now at a rate we know to be low on money we will inevitably pay tax on at an unknown rate. Here's an analogy. If I were lending you money, and when you asked what the interest rate would be on the loan, I said, don't worry about that. I'll let you know when I figure out how much I need. Would you take that loan? Probably not. But by postponing taxation on a portion of our income, we are effectively borrowing money from the US Treasury at an undetermined interest rate. So one of the ideas we commonly use is converting IRA money, traditional IRA money, to Roth IRA, or realizing long-term capital gains rather than delaying them. I talked with another client last week that has some long-term gains in a mutual fund. I recommended they sell the shares and buy them back the next day. They looked at me like I was crazy and said, why would we do that? I said, because based on our estimate of your 2016 taxable income, you will pay 0% on this capital gain. I don't know what the capital gains tax will be in the future, but it probably won't be less than 0%. Of course, no concept is universal, and sometimes we look for ways to reduce current income taxes too. All of this is especially true for business owners. Establishing your business plan for the coming year and integrating your year-end planning with this is the key to making informed and efficient business investment decisions. We understand the tax treatment of investments outside stock and bond funds, and the structure of our compensation model is unique. It liberates us to dedicate the time it takes to help you do the same. So we've talked a little about tax planning. Let's talk a little bit about investment planning. What does this debt level mean to you with regard to your investment planning efforts? Again, let me answer that question with another question. Is government spending inflationary or deflationary? Right. Government spending and borrowing is inflationary by its very nature. As we've seen, our government has been borrowing and spending quite literally like there's no tomorrow. But they tell us, don't worry, there's no inflation. Forget about it. Let's explore that. What comes to mind for you when I say the word inflation? Most people say rising gas prices or the cost of healthcare or education, etc. Truth be told, rising prices are a symptom of inflation. At its core, inflation is the devaluation of our currency, which ultimately leads to rising prices because there are more and more dollars swishing around the globe, making the ones we hold in our bank accounts buy less than they used to. Now, I'm not suggesting that our currency is going to or has already become worthless, as some people would suggest, but in fact, relative to increases in individual income levels over time, we can buy a lot more stuff than middle-class Americans could in the past. But the value of the US dollar has decreased, and especially over the last 20 years. If the Fed and Congress aren't careful, we could easily see a period of very high inflation. Government spending facilitated by ever-increasing government borrowing and currency creation to support that borrowing is inflationary. Without being a conspiracy kook, it's simple supply and demand. The more dollars they create on their balance sheet, the less all the others become worth. Some of you might be thinking, but Brendan, the price of gas and oil have gone down. Doesn't that indicate deflation, not inflation? And the answer is yes. No, really, that is a deflationary indicator. And my opinion is that the decline we've seen in commodity prices, like oil, is an indication that the global economy is stagnant at best and contracting at worst. But that doesn't mean inflation or the declining value of our currency isn't something we should be concerned with. We've seen periods where the economy didn't grow and the purchasing power of our currency declined at the same time. So there remains a distinct possibility that the economy enters a recession and our currency declines in value. So what's an individual investor to do? First, be prepared for the risks I'm describing to take their time playing themselves out. I don't claim to know any better than you exactly when the bond market bubble the Fed has created will pop. So while I'm saying the value of our dollars are declining, we still need some to pay the mortgage and buy the new iPhone. The investments I'm going to talk about are only effective as long-term investments. What's long-term? Forever. You need to buy them and hold them or plan to hold them forever. The only way you can do that is by keeping enough money in stable, liquid vehicles to pay your expenses until the value of those investments has gone up enough to provide flexibility to borrow against them or sell them at a much higher price than you paid for them. I know, that's not forever, but forever is the mindset you need to adopt before you buy them, or you will end up shooting yourself in the foot. One of the things we help our clients do is layer the maturity of their safe vehicles to earn as much as they can on the total without sacrificing objective number one, which is maintaining stability and liquidity. Once you've established and progressed toward your personal safe vehicle objective, you can begin to build value in the assets that will offer the best odds of hedging as many of the risks that I'm talking about as possible. That is, mitigating the effect of our devaluing dollars, but also mitigating the impact of a decline in stock and bond prices that would result from a global economic contraction. So what are those things? I know, get to the good part already. So simply put, the investments that will offer the greatest odds of beating inflation the government is giving us are the things they can't create from thin air with the click of a mouse. Real assets, real estate, natural resources, and the basic necessities we're all going to need for the next 100 years and beyond. I'm a firm believer in the human species' natural ability to adapt. So technology that will propel increasingly efficient use of those natural resources will also offer a significant hedge against declining currency value. Not the technology that scorches our brains and our wallets, but the technology that will help us clean water faster with less fossil fuel, or technology that creates more electricity that costs less and can be stored longer and more efficiently. These are the things that I want to increase my investment exposure to. These are the things that will increase in value over time, over the long term, like forever. I see a lot of people, like almost everyone, with all of their money in stocks and bonds. This is primarily due to the fact that this is what the financial institutions make their money on. But I'm not suggesting you sell all of your stock and bond investments. Even though I think these asset classes are overpriced at best and a bubble waiting to burst at worst right now, they still play an important role in a diversified investment strategy. And like I said, the trends I'm talking about here could take a long time to play themselves out. So I want to hold some money in stocks and bonds for that time period too. So how much is the right amount to dedicate to each category, and what's the best way to approach each category? Well, that's a very personal and individualized matter, and it's different for everyone. And thank goodness, because that's why I have a business, helping individuals and families to develop the optimal balance between all these things while minimizing their exposure to the eroding factors like taxation, banking and investment fees, and inflation is what we do every day for over 20 years. So hopefully this is helpful information. At this point, I'm going to open it up to questions. And let's see, Steve sent a question. So how are these strategies impacted if tax rates don't go higher? Well, that's a good question. And we never recommend that people take all of their money out of IRAs and 401ks, or that they realize all of their long-term gains that they could otherwise postpone. And we don't recommend that people don't put any money into these types of vehicles. What we do suggest is that people not put all of their savings for the future in these vehicles, but that's pretty much what most people are doing right now, and they're setting themselves up for, they're not hedging the risk that taxes may increase over time, which is what we're basically suggesting. Let's see. Dave sent a question. Everyone's situation is different, but is there a guideline for the product mix between investments, insurance, real estate, or safe and risk investments? And the short answer to that is no, not really. There is no rule of thumb that will work for even most people. But as I said before, because the risk vehicles are really the long-term vehicles, and we want to plan to leave them there forever, before we recommend that anybody even get started on buying those things, we want to make sure that they've at least begun to develop a good reserve in safe vehicles. So Mark asks, can Quantum Leap assist me with converting a traditional IRA to Roth IRA, or would I need to do this with an accountant? So yeah, actually we help people do that all the time, Mark. It's one of the things that one of the strategies we focus on, and accountants generally won't advise on that. But we do incorporate your accountant in the process of determining how much to convert, so that whatever we decide on is within the context of all of your other income tax circumstances, your other income sources. Good question. So no more questions, I guess. Like I said, I hope this has been helpful. Feel free to share it, and thanks a lot for joining us. Oh, we got one more. You mentioned real estate. What other types of real estate investments are available outside of actually purchasing property? So that's a good question too. There are, as I alluded, there are a lot of ways you can approach each one of these investments. And so regarding real estate, there are real estate investment trusts and real estate mutual funds, real estate partnerships. These are securities, and they trade on an exchange, unlike buying an individual property where you take title or a deed to the property. There are pros and cons of each, and the pro to investing in real estate through securities like mutual funds and REITs is liquidity. So I can buy shares in a real estate fund today and sell them tomorrow, and I'm probably not going to incur a big cost to do that. Where if I go and buy a rental property outright, and then I try to sell it shortly after, there's lots of transaction costs that go into that I'm probably not going to recover in a short time period. So physical real estate is less liquid. But there are pros and cons to that too. With a real estate fund, because it's so liquid, I could buy it today and watch it go down by 30% in a month. While the value of a rental property that I buy is going to go up and down with demand for properties in that area, it's probably not going to drop by 30% in a month because it's less liquid. Good question. So Anne asks, where will I find the link to this to talk with friends and family? Great question, Anne. We will share that link with you. We have the email addresses for the folks who signed up today, and there's a share button at the bottom of the YouTube screen, which you can use to copy the link as well and go from there. So Mark says, when's your next webinar? Good question. We'll let you know, don't worry. We'd like to do more of these, hopefully every month at some point, but we'll definitely let you know. So any more questions you guys come up with, you know how to get a hold of us. Please don't hesitate to email or call us. Again, thanks for joining us, and have a good rest of the week. Take care.